Welcome to the Deep Dive. Today, we're jumping into the latest earnings call from Electromed Inc. That's ticker ELMD.
Right. Their Q4 and full fiscal year 2025 results.
Exactly. They're a key player in the HFCWO therapy market that's high-frequency chest wall oscillation. Bit of a mouthful.
It is, but it's an important therapy for certain respiratory conditions. And Electromed, well, they've been making some serious waves.
For sure. So our mission today, we're going to cut through the usual earnings call jargon, pull out the key numbers, get into what management is really thinking.
And look at the strategies they're putting in place, because it looks like they're setting up for a pretty interesting fiscal year ahead.
Think of this as your quick guide to understanding what's actually driving this company right now.
And it's a good one to track if you're watching the medtech space. This call really shows strong execution meeting a big market opportunity that's not fully tapped yet.
Yeah, it's not just what they did, but how they're positioning for the future, right?
Precisely. Strategy is key here.
Okay, let's get right into those results then, because honestly, Electromed finished the fiscal year really strong. Q4, record revenue, $17.4 million.
Yeah, that's up 17.3% compared to last year. Solid growth.
And it significantly beat the consensus estimates. The analysts weren't expecting quite that much.
Right. And it wasn't just the top line. Their GAAP earnings per share, the EPS, that also impressed, came in at $0.25.
Which, again, was better than expectations.
Yeah.
So, strong finish to the year.
And the full fiscal year 2025 picture looks just as good. They hit record net revenues, $64.0 million total.
That's a 17% increase year over year. Nice, consistent growth.
But what really stood out to me was the operating income growth. It jumped 46.8% to $9.7 million.
Wow. Okay, so they're growing revenue and they're getting much more profitable doing it. That shows real leverage.
Exactly. They're not just selling more, they're operating more efficiently. And the strength, it wasn't just in one area.
Right, you saw it across the board.
Yeah.
Home care, the hospital segment, even distributors all showed significant year-over-year growth.
That's a really healthy sign. Diversified growth.
And you could feel it in the call. The market definitely liked what it heard. Positive reaction to the numbers and the outlook commentary.
Yeah, the tone was definitely upbeat. This broad-based growth, like you said, it shows resilience. It's not just one product carrying them.
It suggests a solid business model, maybe with wider competitive advantages than you might think at first glance.
Right. Less vulnerability, a testament to their approach.
Okay, let's unpack this a bit more, starting with the financials and that operational strength.
Oh, good.
So beyond the headlines, home care, that's really their core business, their bread and butter, it grew 15% in Q4.
And 15.7% for the full year. That hit $57.3 million. So yeah, a really solid engine there.
But what really jumped out, like you hinted, was the growth outside home care, the non-home care stuff.
Hospitals and distributors, yeah.
Hospital revenue was up, get this, 60% in Q4. 60.
That's huge growth. And distributors were flying too, up 76% in Q4.
And 58.1% for the full year. So what does this surge in the non-home care channels tell you? Feels like a strategic push.
It absolutely looks like strategic diversification in action. They're clearly pushing beyond that traditional direct-to-patient home model, expanding their reach.
And the profitability metrics back that up too, right?
Yeah. Gross margin for Q4 expanded to 78.3%. That's up about 210 basis points, 2.1 percentage points from last year.
And that was driven by a good mix within home care, which is their high margin channel, exactly what you want.
Right. And operating income, $3.0 million for Q4, up 30% year over year. That's a strong 17.5% margin.
Again, showing that operating leverage. Revenues growing faster than costs, more profit dropping down.
It's a clean story financially.
And speaking of clean, the balance sheet looks pretty spotless. They finished the fiscal year with $15.3 million in cash.
And critically, zero debt. Absolutely none.
That's fantastic flexibility. Plus, they generated $11.4 million in operating cash flow. Real cash from the core business.
Which is a very healthy sign. Now, you might see cash is down slightly year over year.
Right, but that's mainly because they returned cash to shareholders, wasn't it? $10 million in share buybacks.
Exactly. Plus, some taxes paid on vested stock. So they're generating cash and deploying it strategically, including back to shareholders.
Which usually signals confidence from management.
It does, although you could argue that using $10 million for buybacks might suggest they didn't see immediate internal projects with quite that high return at that moment. Just a nuance, maybe.
Fair point.
Oh.
But operationally, another big highlight was the sales rep productivity.
Oh, yeah, that was impressive. Exceeding $1 million per rep, that's at the high end of their target range.
And a huge jump from $850,000 just 3 years ago shows real improvement in how effective their sales team is.
That's quality execution, plain and simple.
And it sets up their future growth plans perfectly. They're clearly not resting on their laurels.
No, definitely not.
They increased the direct sales team to 55 reps by the end of the year, and they're planning to go up to maybe 61 home care territories in fiscal 26.
And they're not just adding people, they're raising the bar, lifting that revenue per rep expectation to between $1 million and $1.1 million for FY26.
That's a bold target. Shows a lot of confidence in keeping those productivity gains going.
So the question becomes, how do they support that growth operationally?
Right. And part of the answer seems to be manufacturing. They're adding capacity at their facility in New Prague.
Yeah, that's expected to wrap up early in fiscal 26, and it's designed to let them grow within their existing footprint for the next 3 years or so.
So it ensures they're ready for growth, removes bottlenecks, even if it doesn't directly boost margins right away because of other costs like wages.
Exactly. It's about enabling the future, not just optimizing today.
They're also working on internal processes. A new Salesforce CRM system went live in July.
Right, the CRM implementation.
Now, often you hear about bumpy rollouts with new CRMs, maybe pushback from the sales team.
True, those can be tricky.
But Electromed is saying the initial feedback is overwhelmingly positive. They call it a big step up from the dark ages of fax. What's the real impact here, do you think?
Well, the positive feedback is a good sign they managed it well, but the real impact goes beyond just ditching faxes, though that's huge for efficiency.
Okay.
It's about integrating sales and reimbursement data much better, giving the sales team deeper, faster insights.
So making them smarter, more targeted.
Exactly. Enhancing productivity, finding new market insights. It's crucial for their direct-to-patient model as it scales.
And speaking of efficiency, that e-prescribing thing, the smart order solution.
Yeah, that's interesting too.
It's moving prescription submissions away from fax machines. In Q4, 38% of orders came through smart order.
Yeah, and the impact.
They said it drastically improved efficiency, cut the average days to ship, and the time to get prescriptions approved by almost half.
Wow, that's a massive improvement for getting therapy to patients faster.
Huge win for patient access, definitely.
Think about the patient experience there. Less hassle, quicker treatment. That builds loyalty. And then there's the awareness campaign.
Right, the triple down on bronchiectasis effort.
Bronchiectasis, that's the condition where airways get permanently enlarged, making it hard to clear mucus.
And they've already generated over 31,000 landing page views for this campaign.
So they're actively working to educate people about this condition, which is often under-recognized, and highlighting how HFCWO therapy fits in.
Which connects directly to the market opportunity, right?
Yeah.
It's huge and underpenetrated.
Absolutely massive. In the U.S., there are roughly 923,000 diagnosed bronchiectasis patients.
Okay.
But only about 148,000 are actually using HFCWO therapy, like Electromed SmartVest.
So almost 800,000 diagnosed patients who could potentially benefit but aren't currently treated with this therapy.
Exactly. And then there are estimates of maybe 4 million more undiagnosed patients out there.
Wow. That is a massive runway for growth. It really is like a blue ocean opportunity.
It is. And what's interesting is how external factors are actually helping them now.
Like what?
Well, this recent FDA approval of Insmed's new drug for bronchiectasis. You might think that's competition, but it's actually seen as a positive.
How so?
It raises overall awareness of the disease. More doctors talking about it, more patients getting diagnosed. It's like free marketing for the whole condition.
So even though it's a different treatment, the drug targets inflammation, while HFCWO clears airways, the increased awareness helps Electromed.
Precisely. It funnels more patients into the discussion about treatment options, including HFCWO, which is often considered foundational for airway clearance. It expands their addressable market.
So a rising tide lifts all boats situation. Interesting.
Yeah. And then there's the competitive dynamic in hospitals.
Right. Management mentioned gaining share against a, quote, distracted rival.
Yeah. Apparently this competitor has an older product and maybe some internal issues, creating an opening for Electromed.
And Electromed is using hospitals as a sort of gateway, right? Get patients started on the therapy there, then transition them to home care.
It's a smart strategy. Initiate in the hospital, then capture them in the higher margin home setting.
And it sounds like new competitors are having trouble getting traction.
That's what they indicated. There's a new FDA-approved device out there, but it apparently faces major hurdles because it doesn't have reimbursement set up yet.
Which just highlights how important Electromed's established model and relationships with payers are. That's a real barrier to entry.
Definitely. Those high gross margins help insulate them too.
Okay, shifting gears a bit to the investor context. Electrum got added to the Russell 2000 and 3000 indexes back in June. Why does that matter?
Well, index inclusion is often a catalyst. It forces index funds to buy the stock, which increases demand and trading liquidity.
So more visibility, potentially broader institutional ownership? Good for long-term investors?
Generally, yes. It's a kind of stamp of approval.
Yeah.
But looking ahead, this is where it gets interesting for investors.
They didn't give specific number guidance for fiscal 26, right?
Yeah.
No exact revenue or EPS forecast.
Correct. But the tone from management was very bullish, very optimistic.
What did they signal?
Continued double-digit growth on the top line, expanding operating leverage, so margins improving, and strong operating cash flows.
And their focus seems to be less on flashy new products right now.
Right. More on commercial and process innovation. Things like enhancing that e-prescribing, developing the hospital channel further, using data better.
So disciplined execution, optimizing what they already have.
Which can be incredibly powerful, sometimes more so than just launching something new.
Okay, so for investors listening, the key debate or question moving forward is probably, can they keep up that mid-teens growth?
Exactly. Can they sustain it while managing their costs, their SG&A effectively, and protecting those really strong margins?
The next few quarterly reports will be pretty telling, validating whether these investments in productivity and capacity are really paying off as expected.
It's all about proving consistent execution from here.
All right, now for a little fun. Let's step into the hypothetical world of the investment committee. Purely hypothetical, of course.
The what-if scenarios.
Yeah.
Got it.
Given everything we just discussed, the strong call, the strategy here are a couple of, let's call them wild yet plausible, trade ideas for ELMD. And again, folks, this is not financial advice, just a thought experiment.
Lay it on us.
Okay, trade idea one, the distracted rival play.
Okay.
You go long ELMD, you buy the stock, but you pair it with a short position on that unnamed competitor.
The one management called distracted with the older product, especially in hospitals.
Exactly. The thinking here is that Electromed's focus on hospital sales, their better product, and the rivals' issues will lead to continued market share shifts.
So you're betting on Electromed winning and the rival losing, potentially amplifying your return, a competitive displacement bet.
Precisely. A double leverage play on Electromed's execution. It's bold.
It is. What's trade idea two?
Trade idea two, the underpenetration acceleration bet.
Okay, focus on the market size.
This one's a straight, bold long on ELMD. No short hedge. It's based on the belief that two things will accelerate how quickly they penetrate that market.
Which two things?
One, the tailwind from Insmed's drug-raising disease awareness. Two, Electromed's own efficiency gains, like the smart order system cutting approval times.
So the idea is that these factors combined will unlock that pool of 800,000 diagnosed but untreated patients faster than the market expects?
Exactly. That smart order cutting time to therapy nearly in half, plus more awareness, maybe it unlocks that potential much quicker.
And the 4 million undiagnosed?
That's the longer term, maybe even more explosive upside. If awareness really shifts dramatically, this trade is basically betting on a rapid, significant expansion of their core market sooner rather than later.
Got it. Betting on faster adoption. Both are definitely interesting thought experiments.
All right, so wrapping things up, Electromed Inc. really did deliver an exceptional Q4 and fiscal year 2025.
Yeah, record revenues, expanding margins, and you can clearly see the strategic initiatives designed to keep that momentum going.
Their focus on growing the sales force effectively, boosting operational efficiency, and really leaning into that huge underpenetrated bronchiectasis market.
Plus, those favorable competitive dynamics we talked about, it paints a pretty compelling picture.
Now, as always, please remember, everything we've discussed here is for informational purposes only. It is absolutely not financial advice. Do your own research.
Definitely. As you consider Electromed's path, maybe ponder how quickly those tailwinds, the operational improvements, the market awareness can realistically translate into broader HFCWO adoption and continued strong financial results.
Yeah, how fast can they convert that potential? We encourage you to dig deeper into these themes, form your own opinions.
Thanks for tuning into The Deep Dive.